Hi, everyone. Thanks very much for joining me. I'm here with Elizabeth Yin. Elizabeth is a former founder who's reviewed over 20,000 pitches as a general partner at Hustle Fund and also as a former partner at 500 Startups. Her newsletter is gospel for anyone interested in raising investment and an understanding of what good looks like. I'm particularly interested in reading about all of this, all of your discussions about micro funds and how those are kind of carving out. So would be really interested in talking about that. But thank you very much, Elizabeth, for making the time.
Of course. Thanks for having me, Rob.
So you've been an operator and also an investor. So you've been on both sides of the coin. What's been the biggest market difference from your point of view?
I think that from my perspective as an investor now, although I am investing, I think many people think, oh, starting a VC fund is like working on Sand Hill. It's actually a lot more akin to, I think, being a startup founder because, when you're in a fund, you have to raise the money, which is always a pain in the butt. We can talk about raising money, but as you know, and then market yourself like any other product except mine is money. So I think that it's a lot more akin to being a startup founder than anything, and the salaries are not cushy.
Yeah, I think everybody has this assumption that, oh, you're an investor, that must mean you're rolling in it, right? Yeah.
Yeah.
And when you've written about your kind of challenges in raising a micro VC, what's been the kind of difference between that kind of that life and working for a larger a larger or later stage firm?
Yeah, it's interesting. When we're raising, so we raised our fund one for Hustle Fund, and similar to, a product startup, when you're in the earliest stages of a fund, you have no results, you have no traction really on anything, on any measure. And so the only people who really believe, they're not the bigger funds that invest in VC funds, they're individuals like angel investors. So we're pitching the same people that product startups pitch actually. And what you're doing is you're basically selling the dream around returns. I think in contrast, when I was running, in my ad tech company, you can sell the dream on other things besides returns with angels. Like maybe they love your product and they just want to use your product. That's actually a big reason why angels invest. It's like, oh, I love Buffer, I'm going to invest in Buffer. Mm-hmm. So I think the harder thing about selling the dream on a fund is you have no traction and you're selling returns that hypothetically may or may not exist in 10 years. And there are very few other things that you can sell the dream on. I think for some funds, if you have a particular angle, like we're going to fund more women or fund more people in the Midwest or fund more SaaS companies, then you can potentially use that angle to sell angel investors like, oh, I want to see more SaaS companies come out or whatever. But I think that's pretty much it. And so there's a lot less wiggle room around what you can sell, I think.
Mm-hmm. How do you then, I don't say profile, but how do you kind of profile the right types of investors that are relevant for like a micro fund versus a larger fund? When again, as you're saying, you're kind of you're still trying to compete on returns. It's just you have a heck of a lot less data in the kind of companies you're going after.
Yeah, for sure. So I think similar to fundraising for a product startup, then you are still searching for little angles that you can get. They may not be big, like use my product, but so for example, one thing, geography, I think is an area of arbitrage that not many people use. Like with product startups, for example, sometimes it can be easier to get angel investors who don't have exposure to a lot of deal flow just because they're not seeing as much. It's less competitive, both in terms of attention as well as for ideas. And so, raising from certain geographies, like one of the things that was interesting for us for Fund One is, although we had focused all of our attention on raising money from the Bay Area, actually a fairly significant amount of our investment dollars in our fund actually came from other countries or people in other countries. And it's because they really wanted to get into investing in the US. So that's one angle, like just like where can you present an opportunity where other people don't have access? And I think product startups can use that as well. I think the other thing is around the approach. So there's the model, and every fund invests in a different way. Some funds pick like 5 companies and that's it. Other funds pick 100 companies or and this is a much longer winded story, but our approach was another selling point. I think, one of the things that we do is we invest small dollars because we're a small fund, but also provide some help. So we're not an accelerator, but it's got accelerator as components. And actually many of the people who signed up to invest in our fund one are actually people who previously either managed prior accelerator programs or were mentors in accelerators. And that was something that really resonated. Like, the world actually needs more people to help startups, not just with money, but also with time and skills.
Cool. Awesome. So thinking about some like on the flip side, the very early stage kind of companies that are out there, when shouldn't someone bootstrap a company? This ideal of bootstrapping until exit, or bootstrapping until profitability. When does that usually not happen or shouldn't happen?
Yeah, it's funny, as a VC, I actually am a huge fan of bootstrapping. But obviously there are constraints, right? Like, people may not always be in a privileged position to bootstrap the whole way through. And if you can, that's amazing. And, some of my investors have made, hundreds of millions of dollars that they all got to keep because they bootstrapped all the way. So that's great. But I think if you're going to raise money, or you need to raise money, I think the ideal times are around, I think the number one ideal time is around growth. Like, when you know how to put in $1 into the business and get $1 out. And so you have to have learned a whole number of things about who your customer is, how you get to them, et cetera. And that's the ideal time to raise your first round. But that probably, if I had to put a traction number on it, that's probably when you are doing like maybe, I don't know, 100K a month, like probably like near Series A sort of benchmarks, maybe even a bit later. And so, many people cannot afford to bootstrap up until that point. So I think then the other point would be, all right, well, maybe you have a strong idea of the customer persona. You don't have traction per se, but you have, some early signs of traction. Like, maybe you've got some pilots or at least a few customers who are paying you something small. And in which case, that's probably a good time to go to angels. I think in general, it's just really, really hard to raise from VCs. Just in general, and we can talk about that.
So
many frustrations.
Exactly. So you kind of briefly mentioned that just now, but when someone's working on a very early stage company, they haven't hit that 100K in MRR or anything near to that, but they're interacting with an investor like you or an angel. I think oftentimes people assume that what good looks like, they're looking that you're looking for perfection, and that the business is taking off, and literally all we need is your money to put to fill in the funnel. But in reality, like, what does good look like, and what are maybe some surprising things that people would assume that they need to have figured out that you don't necessarily think they needed to have figured out?
Yeah, that's a good question. So for us, we invest actually very, very early. We're not looking for 100K per month in revenue or anything close to that. In fact, most of our investments are done even before either revenue at all, or maybe people have a couple of sales, but nothing significant. And so for us then, so we're a little bit unusual. Like, actually, I would say there are very, very few VCs playing at this stage, which is why I say in general it's a lot harder, because it's kind of like, well, if we pass and Precursor passes and Unshackled, that's kind of it. But I think what we're looking for in terms of, and this is what I honestly believe every entrepreneur should think about, and something that I have learned the hard way in my entrepreneurial journey, is around unit economics. Mm-hmm. So, at the end of the day, business is very simple. It's the execution that's the hard part. Like, you need to be spending less and making more for your customers. And I think that's something that a lot of people haven't thought about. And so the businesses that I see, like, the way I'm evaluating it is like, what do I think that spread could be? Like, is it large enough to make this business work, such that if the cost to acquire customers goes up over time, and it usually does, it can continue to work? Like, is that spread large enough? So as a result, we tend to end up doing a lot more in B2B, where those margins are just larger. Like, the businesses are paying a fair bit, and you can actually get a customer for way less. in consumer, it's a lot harder, right? Because consumers it's hard to figure out what they spend their money on. And when they spend money on, it's usually not a lot, or people are very price sensitive and things like that. So it's not to say we don't do any consumer, but that's kind of how we think about it. What is that margin? Or if you're not making that full lifetime value on the first transaction or in the beginning, like if it's subscription, like what do we think that could be? Like, is that payback like, 3 months, or is it 3 years? And so those are kind of our considerations when we invest. And it's very hypothetical, to be honest, and based on past experience of trying lots and lots of businesses that have failed because of unit economic problems.
Cool. So on the flip side, what are kind of the common, I don't know if you want to call it face palms, that you sometimes deal with when interacting with founders that I don't know, maybe out of sheer number, people don't necessarily realize that they're doing?
Well, it's interesting when you look at first-time founders versus second-time founders. One of the interesting distinctions is that second-time founders are a lot more attuned to customer acquisition and these unit economics because they've been burned before. Yeah. Like first-time founders tend to think, oh, this is a cool idea I thought up yesterday, but haven't really thought through, well, how am I going to get customers and make money? And it's funny to say that because at the end of the day, that is what business is. But I think almost because all these businesses we're looking at, they're all software businesses. And so people kind of see things from the lens of, oh, the app that I use or the whatever I use in my daily life. And they don't tend to think about it as a business. And that's kind of the distinction between first and second time founders.
Okay, cool. So
as silly as that sounds, but yeah, it is a big distinction.
So you can usually tell a first time founder when you meet with them, just because they aren't able to either have evidence to back up some of this kind of stuff, or at least have an answer to how that might happen, or an awareness that they might not know how that's going to happen.
Yeah, they just haven't. I guess it's partly awareness, but also partly just even prioritizing customer acquisition and thinking that through. Second time founders tend to prioritize it a lot more, like more than even product or anything else about the business, which I think is very interesting.
So, I mean, there's the Founder's Dilemma, the book, The Founder's Dilemma. I don't know if you're a fan or not, but there's this idea of like control motivated people and like kind of wealth motivated people. And I get the sense that someone who has been bootstrapping for a while and has gotten to like a bench, a certain kind of milestone, like 100,000 MRR without taking a lot of investment, is much less likely to, I don't know, be willing to open up their strategy to other people, maybe suggesting changes. Do you find that like control motivated people are much harder to work with, or is that just a kind of common misconception?
I think it's kind of a common misconception. Yeah. I don't know. There are all these business books out there, and I kind of feel like for everything that somebody says there, you can find a counterexample. So
sure. Sure. Cool. So when thinking about your portfolio, what are kind of some of the attributes, and I guess maybe I'm talking about personal attributes, that you see in the founders that you admire?
Yeah. So speed of execution is a big one for us. I mean, I think this is after, assuming we look at the idea and we're like, oh yeah, we're on board with this idea because we think the customer acquisition holds. But in terms of founders, then like speed of execution is probably number one for us, and kind of why we named our fund Hustle Fund. I think what is baked into that is we're not suggesting like people run around like chickens with their heads cut off, but more of, can you focus on that one thing and just like get to that one thing really quickly? I think, as you know, in running a startup, there are 20 million different things you could be doing. How is it that you can really move the needle on that one most important thing? So that's what we're looking for. Like if you're doing customer development, is it taking you, 3 days or 3 months? Mm-hmm. I think beyond that, like what we're trying to assess for, and I think what's very hard to assess for, are other things like, ability to learn new skills and tenacity and all of those other, things that people talk about, but that's obviously very, very difficult to assess in talking with folks. I think speed of execution is a little bit easier because you can ask about timelines of, oh, when did you do this and when did you do that, and just kind of assess that way.
Cool. You do write sometimes about investing outside of the Valley and outside of Northern California. What are kind of the benefits and drawbacks of investing outside of your geography?
Yeah, I actually really love investing outside of the Bay Area. I think this place has a lot of noise. I think from an investor's perspective, it's also more competitive. But I think and I think the flip side is in other geographies, there's a lot of talent now sprouting up in various places that didn't necessarily happen before, just because like knowledge is more democratized. Like you can learn about lean startup online, and you know, you have great startups that may not have access to capital and resources outside the Valley. So I'm a huge fan. I think in terms of answering your question of like, what are the differences? There is one difference though, or maybe it's kind of one and a half, like around scaling.
Mm-hmm.
I think that's still something where the Silicon Valley has a huge advantage, both in terms of people who have done it before, like just sheer number of people who have worked at Facebook and Pinterest and Twitter and lived through the good, the bad, the ugly. And then, but also scaling knowledge and then also aspirations, like everything involving scaling, I think is an area where the Valley still has an advantage, where that information and people don't necessarily exist in other cities. It's changing, but not quite there. So one of the things that I do notice then as a result of companies that can get to a certain level outside of the Bay Area, if they want to go big, then they tend to open up a small business office in the Bay Area where they can then get funded by, you know, Silicon Valley VCs and, you know, get into sort of some of these in circles where people really do share about like how they've scaled their companies.
Okay, sure. Like products being built outside, but leadership comes back and business and sales and right.
Yeah, and this model is actually very interesting. I mean, I think you see it both domestically and internationally, like Intercom and TalkDesk. They both have huge offices. Founders are from Ireland and Portugal. So they have huge offices outside the US, but they also have offices in San Francisco. And that works out well because you can take advantage of talent that is, you know, cheaper outside of the Bay Area. Like housing costs around here are ridiculous. And then it also applies domestically, like you see other, you know, companies outside the Bay Area in the US that have offices here too.
Cool. So thinking about geographies outside of the Bay Area, are there any that are particularly exciting for you, like specific ecosystems that you think just are interesting from the deal flow perspective?
Yeah. So not in the US, but I love Toronto. That's my favorite city to scout for companies. I pretty much consider them American. And I think the main reason is just from a sheer volume perspective, like there's a lot of tech talent there and people are starting a lot of companies there. Certainly we have portfolio companies. You know, when I actually graphed out where all of our portfolio companies are from, it's funny, like actually number one is still the Bay Area. We still have 40% of our portfolio in the Bay Area. That will probably reduce over time to maybe a third or 25%. But then outside of that, like, you know, Toronto, we have a whole handful of companies, but then after that is like one or two hodgepodge here and there, like two in Seattle, one or two in Chicago, you know, things like that. And so I think, I think for me, actually, the realization is it's less about running around now from city to city, like trying to, you know, plunk down your flag and form your brand, but more like, okay, actually VCs should be marketing themselves online. Yeah. Like, you know, everybody's reading everything online these days, and you should be able to invest in a startup anywhere if you can kind of build that relationship online. And so that's kind of our strategy rather than trying to run around, you know, 20 different cities.
Sure. Okay. All right. So geography doesn't really matter specifically, no. but perhaps it's more interesting if they're just not outside the Bay, or if they are from outside the Bay Area.
Yeah, it is more interesting just because there's less competition and, you know, I think both in terms of with other VCs and also in valuation and things like that.
Exactly. Cool. So just thinking about what like VCs and maybe the kind of larger syndicates or angels can do to increase representation. Are you seeing, are there things that you see certain VCs or investors doing that is quite interesting or innovative, specifically focusing on increasing representation from founders that don't look and sound like me? What are those?
Yeah, I think there are kind of two very interesting angles these days. So one is you see the rise in many micro funds or nano funds or whatever you want to call them. Like there are now hundreds of like $5 million funds here and there. And they're going after different geographies, different demographics. And so I think that's very exciting. I mean, I think to highlight a few like SoGal, like funds, you know, businesses where there's at least one female founder or strong female leadership. Arlene Hamilton has Backstage Capital, which funds, you know, underrepresented minorities. And so you have a whole slew of funds kind of in this category. And then you have a whole slew of funds going after actually a very different type of company as well. So Clearbank is actually very exciting. They're a revenue based fund where they say, hey, we're actually not going to take equity. We'll give you money, but in exchange we want to do like a rev share. So this is great for actually more bootstrap founders where it's like, I've kind of figured out what's working and I'm pouring in, $50,000 into ads a month, and I need more capital just to keep doing that to acquire new customers. And Clearbank says, well, instead of raising VC money and spending it all on ads, raise our money and then, pay us a percentage, and then we can pour that back into reinvesting in your company. So it's not quite a loan because there isn't the same default mechanisms and payback period and all that, but it's a revenue sharing based model. And there's a whole slew of funds now popping up in that category that are not equity based funds. So they're technically, I guess, not even VC funds, but very much going after working with startups in a different way.
Cool. Well, that's it. I really appreciate your time, and especially when you're not feeling so well. Just really appreciate you kind of spending some time and talking to us about these things.
Well, thanks for having me, Rob. Appreciate it.
No worries. All right. Take care.
Thank you. Take care.
Yeah.